So, the reason I wanted to go live today was to look at what's going on in the uranium market. The uranium market is on fire right now. There's some weird, strange things happening, and I think it's going to get weirder and weirder. And it could mean that the market for uranium gets cornered, and we could see uranium prices like double or triple in the next month. And these uranium stocks are actually moving up already pretty heavily. So you can see some of the big uranium miners like Cameco are moving up, as well as a lot of the smaller junior uranium miners as well. You can see like Next Gen Energy, one of the ones that I think could be a stock that goes up another probably 50 to 100% in the next month potentially. It's kind of a weird, risky trade, but the whole idea is super fascinating. So basically, the uranium market is a market that's controlled by three main producers. There's like three major producers of uranium in the world. There's Cameco, there is Kazatomprom, and there is, I think it's Aramco. It used to be called a different name. France Uranium Nuclear Company. I'm going to Google it because I forget the name. It used to be called something else, but yeah, the French Nuclear Power Company. Let's look it up. I forget. It used to be called something else. Areva. It used to be called Areva. It's now called, I believe it's called Aramco. What is it called now? Orano. That's it. Orano. They're the other third largest producer. I guess that's private. But point being, uranium market is like this super sleepy market. You know, nuclear reactors across the world mostly like transact in long-term contracts for uranium. So they buy like uranium 5-10 years out that they're going to need to run their nuclear plants. But occasionally there are utilities that buy in the spot market and they need to like get more extra uranium because they're short, because the miners didn't deliver enough because their plants were down or whatever. So there is a spot market for uranium, oddly enough, where you can buy physical uranium or even trade uranium futures. So if you look here on TradingView, for instance, it's very thinly traded, but you can see some pricing from the uranium market. And over the last 5 years, uranium prices have generally been on the rise. But what's super interesting about this is that it is believed that a lot of the producers aren't really making money below $30 a pound on uranium. And there's thinking out there that the uranium market is going to be short of supply come like 5 years down the line. And so people have been slowly pushing their way in the uranium market, thinking that the uranium prices could go to $40 or $50 a pound. We're at about $33 today in the futures market for uranium. But here's what's interesting. So just a couple of weeks ago, there was a closed-in fund run by Sprott, which is a large investment firm out of Canada. And Sprott has like gold ETFs and closed-in funds and silver closed-in funds, and they focus on commodities mainly. And they have this Sprott Physical Uranium Trust, which is kind of like GBTC is for Bitcoin, where the money that they take in from investors essentially has to get deployed in physical uranium. And the more money that comes in, the more uranium they buy. And so there's kind of a short squeeze happening with the Sprott Uranium Trust, and the more money that it attracts, it's very like it's a self-perpetuating cycle essentially. The more this uranium trust goes up because uranium prices are going up, the more money floods in and the more uranium it has to buy. So it's essentially cornering the uranium market. And the spot market, I think, could see prices spike up almost like a short squeeze to crazy levels. Could be 40, 50, 60, I don't know, $100 per pound for uranium at some point until the utilities and the regulators figure this out. But these, smaller uranium miners, there are some smaller ones that have like projects that they're trying to get online to be able to produce uranium. And there are some very, very small producers outside the big three. Some of them are publicly traded here on this list, you can see. But they've already started to run up a lot. You can see like Next Gen Energy is up a lot this year. Like even since the beginning of the year, let's look. It started the year at like 350. It's essentially doubled. Just in the last few days, the stock has been up like 70, 80%. And you can see that the market's starting to figure out that there's this potential for a cornering or a short squeeze in the physical uranium market, which should benefit a lot of these producers, smaller producers especially. And so this is kind of an interesting trade. We're headed into a 3-day weekend. I know there's some big hedge funds that have started to discover this trade in the past few days. And so there's more people that are piling in, more institutional investors and more individual investors as well. So that is creating a really interesting situation here where I know these things have run a lot already, but this could be one of those crazy situations where we see some of these uranium producers run to silly levels. You have this one's a little harder to buy. This is Kazatomprom, one of the largest, if not the largest producers of uranium in the world, trades in London and in Kazakhstan. And you can see here, this one probably has a lot further to run. And then obviously the smaller players as well. You've also got some other ETFs or closed-end funds that mimic the price of uranium, like Yellowcake, which trades on the London Stock Exchange. You can see that one started to move up. I think we're still in the early phases of this. This could get crazy. This could get crazy to a level, I think, where it starts to alarm the regulators. Because I think at some point what happens is the utilities and the nuclear regulators figure out if uranium goes to $50 or $100 a pound because of all this, they're going to have to kick the speculators out of the uranium market. But for right now, I think everyone's still asleep at the wheel. And so I really like NextGen Energy because, they're traded in Canada. There's not as much political risk with that one. They have some pretty good uranium deposits, and, they've got the potential to become a much bigger producer over time. So I kind of like NextGen, but honestly, I think you could probably buy a small basket of some of these uranium stocks, and it's going to be a higher risk trade for sure. You can see how quickly these stocks have been up just in the past few trading sessions. They could take a breather potentially, in a few days. If the flows into the Sprott Uranium Trust slow down for a little bit, you could see these things come back off a little bit. So just keep that in mind if you are entering this trade, but I do think it's pretty fascinating what's happening here. So like NextGen Energy, ticker NXE, that trades on the TSX. Here, I'll try to blow this up so you can see it. You can see I have a list here on the right side of my trading view watch list. You can see these are some nuclear energy and uranium related companies, and you can see which ones are getting a bulk of the uptrend right now. It'd be like smaller ones like Paladin Energy, which trades, I believe, on the Australian Stock Exchange. You've got Vimy Resources, Australian company as well. GoviX Uranium, which trades on the TSX Venture Exchange in Canada. So that is GXU on the TSXV exchange. That's a small cap. That could run to several dollars a share. We also have Boss Energy, which trades on the ASX. Again, a very, much smaller cap company. Energy Resources of Australia. So as you can tell, a lot of the smaller uranium producers, a lot of them, frankly, don't even have production, being produced. They don't have any producing mines yet. They just have deposits that they want to get funded for mines. And so, so that is something to keep in mind as well. These are very speculative in a sense. I'm going to turn down these lights back here. Let's just double check and see if we can turn these lights down a bit. I know it's kind of bright back there. So yeah, is that better? It's a little better, I guess. Let's see if we can turn these down too, maybe. So that's the trade idea here. Uranium, very, very interesting. You've essentially got Sprott Uranium Trust starting to corner this market. And all of these small producers and potential producers are going to benefit. So on TradingView, it's the Sprott Physical Uranium Trust trades under U.UN, I believe. And you could buy that if you wanted to get, just access to the Sprott Trust directly and be able to buy, they're just buying physical uranium. But I kind of like playing some of these stocks. You can see the big moves on some of these smaller cap uranium producer stocks. My plan is, buy a couple of these shares now and see if you do get a pullback next week to maybe add a little bit of size to it. But again, these could just keep running. I really like NXE. I really like, you could buy Kazatomprom, the big one, although that's a little harder to buy. Something like GoviX out of Australia. Those would definitely be some candidates here. But yeah, this is going to, Yellowcake out of London on the LSE also has direct exposure to uranium prices. So yeah, I mean, this is this is, I think, a trade that's run a decent amount that could continue to run a lot higher as we see Sprott buy more and more of the uranium market. The uranium market is very, very thin. There are not very many sellers. And so as Sprott takes in more and more money into their closed-end fund, they're forced to buy at higher and higher prices. And that just reinforces this feedback loop over and over and over. So until this gets shut down, we have a situation here where this thing's probably going to create a massive squeeze, a massive run up, and essentially cornering a small commodity market, the uranium market. So that's what's so fascinating here. But yeah, the uranium market's so funny. It's weird. I've studied it before in the past, and we've seen prices in the past. Like if you look at uranium futures, if you go back a little longer, you can see here that on the chart, let's go back like, a bunch of years, as far back as TradingView will let us go, which goes back to like kind of early 2000s. You can see it's been as high as $100 a pound before. There has been a squeeze in the uranium market before. It's just been a long time since we've seen it. And you can see this chart is rounding in kind of like a cup formation, and we've got a long way to go. I mean, physical uranium prices could easily go to $50 per pound, and I think you'd see the uranium stocks double again from where they are today. So, in Sprott, Sprott just got this thing approved. Let's go ahead and see if we can pull up some information on it. But you can see this was just started, like I think a couple of weeks ago. So you can see here, this is a press release from July of 2021. This was July 19th. Sprott, a global leader in precious metals and real estate investments, announced today that its wholly owned subsidiary, Sprott Asset Management, has successfully completed its previously announced transaction with Uranium Participation Corporation, and that UPC's shareholders are now unit holders of the newly created Sprott Physical Uranium Trust. Trust begins trading this morning on the Toronto Stock Exchange under the symbol U.UN in Canadian dollars and U.U in US dollars. So this transaction adds approximately $600 million to Sprott's total AUM, blah, 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 blah. And the Sprott Physical Uranium Trust is the world's largest publicly traded physical uranium fund. And so this is a pretty big deal. This just happened about a month ago. This thing started to trade. So, well, I guess about a month and a half ago now. But it's really been increasing its buying power just in the past couple of weeks as it's taken in more and more assets under management. So you can see here, it does trade at a little bit of a premium to its net asset value. And you can see the net asset value today is about $858 million. So it's already grown by about a third in a month and a half. And you can see the total pounds of uranium. It's got, almost 22 million pounds of uranium already owned. I don't know where they hold this stuff. I really don't know where they actually store this. And frankly, it's kind of scary that an investment company is allowed to buy this much uranium. It's not enriched uranium, of course. That would be a real concern. But nonetheless, you can see here, this is such a funky situation. But yeah, I mean, this is going to create some really, really interesting dynamics in this market. So this is going to be a market to watch for the next few weeks and months. And I think, we could be looking at all-time high prices potentially, or getting close to those in the actual uranium commodity in the spot market. And then that could mean, a lot of these uranium stocks double. So, and just you can see how thin the uranium futures market really is. If you look at the front month contract, it's very little volume. There's a couple hundred contracts, maybe 1,000 contracts at most traded at any given time in the futures market. And then in the actual physical market where Sprott is transacting, I don't even know how much is available for sale there, but it can't be that much on a daily or weekly basis, especially at this point. So yeah, and we could look at some other commodities for similar situations. Like I know palladium. Palladium's had some pretty crazy spikes in the past, right? You had back in the late 90s, early 2000s, palladium went through. It went from 100 or just over 100 to, 1,000. So it almost went up 10x in a matter of a year or two. That happened again back in like 2009 to 2011. You had it go from 184 to 800, so about a 3 to 4x. So again, there is precedent for stuff like this. Of course, silver, if y'all remember, if you've ever read about the Hunt brothers, and I don't know that the silver futures are going to go back far enough. Let's see if it will let us go back. Yeah, so back here in the late 1970s and early 1980s, there was a couple of investors, the Hunt brothers, and they cornered the silver market. And you can see the silver market went from like, 460, 470, just over $4 basically, to per contract to about 40. So it went up about 10x, about 1,000% in the matter of a year or two in the silver market when that commodity was kind of cornered by the Hunt brothers. And of course, we also have seen BTC and what GBTC did to that last year. So there's a lot of precedent for this. And yeah, I mean, I think, a lot of people believe that GBTC was a big buyer that was partially responsible for this big Bitcoin move earlier in, 2020, 2021 timeframe. So yeah, this is pretty wild stuff. Like, I think this has the potential, like I said, for uranium to go to somewhere between 50 and 100, maybe even more per pound. And that would mean that these uranium stocks probably double or triple, or maybe some of them even go up more than that. So exciting times in this uranium market. Yeah, so Noah, if you're coming in late, this is TradingView, by the way, John. This is just a platform I use to keep watch lists and track different stocks and stuff. So like, for instance, I have a nuclear energy list where I keep track of some of the stocks in the uranium and nuclear market. This isn't an exhaustive list either. There's definitely some other smaller uranium stocks out there worldwide, but these are the ones that I've been tracking. So to kind of recap, Noah, basically what's happening in the uranium market is this summer, Sprott, which is an investment firm out of Canada, created Sprott Physical Uranium Trust and has been buying lots of uranium on the spot market. And they take in more capital every day, and it's a self-fulfilling prophecy in a way. It's a self-perpetuating cycle, because the more capital Sprott takes in, the more uranium they buy, which puts more and more upward pressure on uranium prices, which means people see the price going up, so they want to get some of this action. So people are just piling in more and more into what is a very thin volume market. And so you can see, like, if we look at the Sprott Uranium Trust here, year to date, you can see just in the last couple of weeks, it's gone from 10 to almost 14 today. And that's just the uranium trust. And then all these other uranium miners, which could benefit from higher uranium prices, have been going up quite a lot over the past 2 weeks. You can see in just in the last 5 days, GoviX, up from the 20-cent range to almost the 40-cent range. One of the ones I like out of Canada, Next Gen Energy, just in the last 5 days is up from, call it $5.60 to $7. In the last month, the stock is up from about $5 to $7, and I think there still potentially could be more to come. So this is a situation where you've got a buyer of the underlying commodity that is price insensitive, meaning they don't care what the price is. If they get assets into the fund, they buy more uranium, meaning they just keep buying no matter what the price of uranium is. And we are seeing the uranium futures and the uranium spot prices moving up. And as they move up, it's a very thin market, very thinly traded. It's you can see here hitting kind of multi-year highs, and still with a lot of potential ways to go. If you look back in the past, we've seen uranium at the $90 to $100 per pound level. Today we're at 33 and rising. I think it could get to 50 plus, and that therefore some of these uranium related companies could be up a lot. Now, I do think at some point, like I said, the regulators will come in and shut this down. If there are utilities that don't have enough uranium and they're having to pay crazy prices, they're going to whine to the regulators, the federal regulators in their country, and you could have a situation where eventually there's going to be a backlash against the Sprott Uranium Trust and the fact that investors are participating in the uranium market, which is a strange market to allow investors to participate in. So that's what's going on in uranium. It's a funny situation. Let's keep an eye on this. We have a long weekend here in the U.S. There's a holiday on Monday, so our market will be closed. I'm not sure about the Australian markets or not. I think they might still be open on Monday. So we'll have to watch what happens with some of the smaller Australian producers. Frankly, they've been some of the ones that have been going up the most in the last couple of weeks. So you can see Paladin was up 24% today. Vimy was up 23% today. Goviex was up 14%. Boss Energy was up about 12.5%. Energy Resources of Australia, ERA, was up about 10%. So some of these smaller ones out of Australia are definitely getting a lot of the love here. Yeah, so John, you're asking if there's a risk to the regulators coming in before the party really gets kicked off. Yes, but I doubt that, the regulators are so slow. They're so dumb. They're so like asleep at the wheel that unless the utilities kind of tip them off early, I think you have uranium going to 50 plus before anyone really notices. Because one of the weird things about the utilities and that are buying in the uranium markets is they have a lot of long-term contracts with the big producers like Cameco and Kazatomprom, and they don't necessarily buy a whole lot of spot uranium, but they might be buying a little bit here and there, so they might not notice it until it really starts to hit their financials, and that probably isn't until we're at $50 to $100 uranium where the utilities start to actually notice that their spot buying is getting way more expensive. So their prices are locked in on most of their volumes for 2021, 2022. But as you move out to 2023 and 2024, as the utilities start to redo contracts, then the producers of uranium are going to be like, yo, by the way, instead of contracting at $30 or $35 a pound like we have been in the past, the current uranium market is saying it's 50 plus, so we're going to need to reprice you at 45, 50 plus of, uranium. So that is going to be interesting to watch how it evolves. But yeah, I don't think the regulators are going to step in yet. I think they're going to be behind the curve as they almost always are. So I think we're probably looking at maybe a month or 2 or 3 at least of rising uranium prices, maybe rapidly rising prices before the regulators actually step in and figure out what's going on and try to shut it down. So I think that's what will happen. I don't know for sure, right? But I think that's my sense. And just having seen regulators act, they're very reactive, not proactive when it comes to regulation. So that's kind of my thinking at the current moment. Yeah, so Olga, it's definitely a manipulated market. Uranium is definitely one where very significant players, both on the utility side and on the producer side, can create a lot of strange price action in uranium historically. But that's where Sprott coming in is kind of changing the game. Like, what's new now? Like, that's always the question you got to ask yourself is like, what is different now? What is different now is that Sprott Physical Uranium Trust is a big player now buying up uranium more so than probably any other utility at the moment in the spot market. And they keep getting more money. That's the thing here. This Sprott Physical Uranium Trust gains assets as more and more investors buy into it. They gain those assets. It's a closed-in fund, which means they take in capital and they have a mandate to go deploy that capital into specifically physical uranium. And so the more this goes up, the more money flows in. The more it goes up, the more money flows in. And that's what's new now about the uranium market. And I think Sprott is going to be able to push this thing around in a big way, in a way that like smaller players haven't been able to do in the past. So the days of the utilities and the big uranium producers dictating terms in this market might be starting to wane a little bit, at least in the short run. So that's kind of the thinking here. Pretty interesting situation, I think, overall. Yeah, so yeah, I know it's starting to get some play out there. I think we're still early. I think it's like the second, or if this is a baseball metaphor, it's still like the second or third inning out of 9 innings, right? It's still early. I know the stocks have started to move up. You started to see some YouTubers maybe talk about it a little bit. You've started to see some people on Twitter. Like one of the guys who kind of kicked this off was a guy named Cuppy. What's his real name? I think it's like Harrison or something. Yeah, this is his Twitter account. He's pretty widely followed. He's got 27,000 followers. Harris Kupperman. He runs a pretty good little newsletter business. And it's got some, interesting stock ideas in there occasionally, but he's been all over this trade. Kudos to him. And so you can see he's been tweeting about the Sprott stuff. And he said that, basically he's been like heavy in this trade. And he's got some tweets here about it. But there's definitely some people that are out there, and you can see Sprott Asset Management has been tweeting about this as well. You can see that, like the Sprott Asset Management has been tweeting specifically, another active day for the Sprott Physical Uranium Trust with 800,000 pounds of physical uranium added today, powered up. So they just keep buying more. But yeah. At some point, the new capital will stop flowing in. But listen, I'm here to tell you, and sorry for the noise, the lawn guys are here. I talked to a buddy of mine in the hedge fund industry yesterday, and he was telling me that one of the largest funds out there, they run about 20 billion, was getting into this trade this week, that they had just sort of like caught wind of it. And so their event desk, their event-driven desk, actually is now getting into this trade. And so the big institutional money is even getting involved in this trade. They kind of are circling, it's the sharks smell the blood in the water kind of vibes here. So they're coming for it too. The institutional money's coming. So we're still early in terms of the money pouring into this trade. I think, I'll get a lot more concerned when these stocks are up another 100%, when uranium prices themselves are up another 100%. Like when we're trading at 60 or $70 per pound of uranium, then I'll be a little bit more concerned about, maybe is it time to take profit on the trade? Maybe is it time to get out before this gets too overheated kind of thing. But right now, I still believe it's early days for this. So let's keep an eye on this. Olga, you're right. So that's a good point. Olga's saying, Cameco still has obligations to sell their uranium at certain prices. That's right. But, it's sort of like if you think about the oil markets, there are contracts between oil producers and oil users to, I'm going to sell you X amount at X price, no matter what the futures are doing, right? Like if you look at, let's go ahead and pull up some oil futures here, right? We'll pull up the front month crude contract, right? Or we could even pull out like let's go out to like the crude futures contract going out to like 2023. Let's look at the Jan 2023 futures contract. You can see crude oil futures for delivery in January 2023 are trading at $63. So you've got some producers that, have contracted at 63. You've got some users that have, contracted at 63. But what if crude prices tomorrow, what if front month crude prices go to 70 or 75 or 80? There are going to be some spot market buyers that, didn't lock up all of their production or all of their demand at these later prices. And, they got to access in the spot market, right? So it's the same idea in uranium. It's like most of the big producers have contracted with most of the big utilities for the next couple of years, their estimated needs. But estimated needs are also a funny thing, right? What if a utility has only contracted 90% of their estimated needs, or there's a spike in demand for their power source, right? Then in that case, you could have them needing to buy some in the spot market. And so even though it's a marginal amount, it might only be 5 or 10% of their needed uranium, they got to go into that spot market and buy, right? And so it could be significant volumes too. And so if, we're already seeing Sprott pushing up the spot market to $50+ per pound, then those utilities are going to get caught a little bit short of uranium and they're going to need to buy, right? So it's not like every single pound of volume that's used of uranium has to transact at these prices. It's just that the marginal supply or the marginal demand for that commodity that trades in the spot market. And so thankfully, the nuclear utilities across the world have contracted a decent amount of their supply from Cameco and Kazatomprom and Orano. But the ones that have a little bit of excess need are going to be in kind of trouble there. So it's not going to shut down nuclear plants worldwide, but it could create a little bit of financial pressure for some of the ones that have a little bit of unmet demand or unmet supply constraints, right? So yeah, that's yeah, and it could also force some of these big producers like Cameco and Kazatomprom to actually reprice their contracts higher because they've been kind of getting screwed by the spot market in recent years, and they have been trying to raise prices for their utilities customers, but they've been relatively like constrained because there's all this supply of uranium that's been coming from old nuclear weapons that have been decommissioned and things like that over the years. And so that has kept a lid on prices, and that's kept the ability of Cameco and Kazatomprom to like really price higher. But now, if you've got Sprott buying up all this supply, now it's actually Cameco and Kazatomprom probably love this because now they see the spot market going to maybe 50 plus, and all of a sudden they can go back to their customers and be like, all right, y'all, I'm sorry, but we gotta hike prices. We'll give you a discount from the spot market. The spot market's trading at 60. Listen, we'll give it to you for 45 or 50 a pound in 2024 and 2025. That's what they're going to love to do because, look again, we'll just take another look at uranium prices historically. I'm going to look at the futures here. And if we go back, you can see this has been in a downtrend for the better part of a decade, from call it, really it was in a pretty big downtrend from like 2010, 2011 timeframe when it was trading above $60 a pound. Uranium has pretty much, it bottomed out kind of 2017 in like low 20s, but it was down almost 2/3. From 2010 on to like 2017. So these uranium producers for sure are going to love higher prices. And if you look at a Cameco chart, you can see the effect of the low prices if you go back. This is what happened, by the way. Look at Cameco in the early 2000s. It went from $5 a share to about $50 a share. It had a 10-bagger when uranium spiked last time. And then, of course, it sold off for many, many years, and it was a kind of a dog stock. You would have lost like 75, 80% of your money until like late 2017 when it finally started to recover. And really, it didn't really start to recover until like late 2020. It was still a $9 stock, and now today trading at about 21. But could this thing double again if uranium prices go to 50, 60, 70, 80 a pound? Probably so. Probably so. It tends to trade very correlated with uranium prices. So, yeah, that's why I think, again, just lots of interesting aspects to this story. But yeah, let's talk about whatever y'all want to talk about now. What else are you watching out there? I know we just trading day just closed here in the U.S. Unfortunately, the markets will be closed Monday, which is a bummer because I always love when the markets are open. But it's kind of nice to have I guess a break sometimes too. What are y'all looking at? What's been on your mind this week in the markets? I know it looks like markets were kind of flattish today. Probably a lot of traders and investors went home. Let's see, where did we finish the week here? Let's look. Let's take a look. Looks like S&P up about 0.5% this week. NASDAQ up about 0.5%, or I'm sorry, 1.3%. Small caps, the Russell was up about 0.6%. So it was kind of like a modest week in the markets. Still mostly grinding higher. Like if you look at the S&P, S&P just continues to kind of grind higher and higher. It has had how many? Let's see. Let's look at a weekly chart. On a monthly chart, you can see 1, 2, 3, 4, 5, 6, 7, 8 months straight of gains in the S&P. At some point, this thing's got to have a correction, right? On a monthly time frame. But it's still just powering higher. Looks like, crypto's been pretty strong this week. Bitcoin above 50K. Ethereum pushing that 4K level. Bonds starting to like, they were starting to kind of creep up a little bit. Up a little bit today, it looks like. But not a lot happening there, to be honest. Silver and gold were kind of perking up, like silver today, and maybe this could also have something to do with what's going on in the uranium market. I don't know. A lot of times commodities will trade correlated to one another, but gold and silver were also up today. Gold was up about 1%. Silver was up about 3.5% today. So, it's interesting. Let's take a look at the 1 month chart here. Actually, let's take a look at the year to date. I'm going to remove this indicator. Yeah, I mean, you've got silver actually pretty strong move here, just in the last couple of days here. But moving off kind of a weak technical pattern here on a longer term time frame. Hey, Enrico, good to see you, man. Thanks for joining today. Yeah, so Chinese stocks, kind of interesting, right? You had Alibaba come out and Tencent come out today and say that they're going to give the government tens of billions of dollars as a way to make nice. But maybe this finally means that Alibaba and Tencent and the Chinese stocks can get up off the floor. It's unclear because a lot of U.S. investors won't touch these Chinese stocks now. So I don't know if they're ever going to get that much of a multiple anymore. The perceived political risk now is very, very high. It's going to take a while for these stocks to kind of work out of that funk, if ever. So you can see, though, Alibaba pledges 15.5 billion to Beijing's Common Prosperity Drive. This is essentially Alibaba saying to the government, we're going to give you a bunch of money. Please leave us alone. Alibaba pledges to invest the equivalent of 15.5 billion over 5 years towards Beijing's Common Prosperity Drive. So this is a redistribution from the big tech companies to Chinese citizens. And, it's a way for Alibaba and Tencent and JD and, Baidu and those kinds of companies to try to make nice with the government. Alibaba's investment follows a $7.7 billion pledge from Tencent. So, that pretty much, I think, wipes out a big chunk of Alibaba's annual profit, right? Let's take a look real quick at, why don't we pull up Koifin here? Take a look at Alibaba, look at the estimates here. So Alibaba does about 30 billion a year right now in earnings before interest, taxes, and depreciation. Call it that's basically the level of annual earnings. So 1 year of earnings is about 15 billion or so for Alibaba, and that's essentially what they're committing to the government over the next 5 years, is to pay out like a full year worth of earnings for this make nice payment. And that's not the end of the world for Alibaba. And you can see here, it trades for like a market multiple, or actually a cheaper than market multiple, price to earnings multiple. If you look historically, if you believe Alibaba's numbers, there are some people who believe that Alibaba's accounting is shady. There are some things, especially from earlier in Alibaba's history, that do suggest they were fudging some numbers. I'm not sure if that's still true today, but let's just look here at the price to earnings multiple chart. Over the last 5 years, you can see this is the lowest PE multiple pretty much that Alibaba has traded at. Alibaba, because it grows at like 30% plus a year, has historically been trading kind of in the 20 to 30 times price to earnings multiple on average. In fact, kind of closer to that high end of that range, 30 times or so. But today, trading at a very reasonable, if you believe the numbers, 17 times earnings. And so the idea is if they continue to grow earnings and the earnings multiple can get a little bit of expansion, you could be looking at a pretty nice, maybe 50 to 100% return in the next couple of years in Alibaba stock. But again, the big risk is political. There's a whole lot of unknowns. There's the whole legal structure issue with Chinese companies trading in the U.S. When you buy Alibaba trading in the U.S., what you're buying is a variable interest entity, a VIE, a Cayman Islands company. You're not buying the Chinese domiciled company. You're buying a Cayman Islands subsidiary company that has a contract with the Chinese company to extract a lot of the economics out of the Chinese company. And so China still does not allow foreign investors, like U.S. investors, to own stock or equity in Chinese companies. So the workaround that we've had with these Chinese companies for the last decade or two is that they have these Cayman Island-based subsidiaries, and the Cayman Island subsidiaries have a contract with the actual Chinese company to take dividends or to get the earnings of those companies. And the risk there obviously is that if the Chinese government ever says, you know what, we won't allow these Cayman Island companies to have contracts with our Chinese companies, then you have no recourse. You don't own equity in the actual Chinese company. You own equity in a shell company in the Cayman Islands that could just get cut off by the Chinese government at any time. So, I mean, technically, Alibaba and Baidu and JD could go to zero. Their stocks that trade in the US could go to zero. The Chinese companies themselves have real earnings, but as US-based investors, we can't actually own a real piece of the Chinese company. We got to own these Cayman Island companies. And that's always the risk, right? You have a small probability, a very small probability, that these stocks could get wiped out by the Chinese government. And we have seen political tensions between the US and China rising over the last few years. Who knows what could happen with China and Taiwan and the shit show that could bring. So these risks exist, and probably that means that these stocks like Alibaba and Baidu and JD will continue to trade at below the earnings multiples that they have historically and below the market average, probably, at least for a few years until investors get comfortable again. If nothing happens with the Chinese government for a couple years and they kind of stop pestering the big tech companies, then I think slowly over time, maybe investors get confidence again, and then you could have the confidence return and the earnings multiples start to rise again. But right now, there's a lot of institutional investors that have been burned by the Chinese government, and they don't want to get back into these stocks yet. There are some, however, that have seen this as an opportunity. So it's too early to know who's going to be right here. But I do want to point out, you have a lot of unusual political risk that you wouldn't have with a typical company trading in US or Canadian markets. So keep that in mind. I think personally, I have a small position in Baidu, and I think, I'm probably going to continue to hold it, but I've got to keep it size small. I'm not going to add to it just because I can't make it a big position, because that small probability that it could go to zero overnight is significant, and I don't want to take that big of a capital loss. So I've got to keep that sized really, really small. So I would just encourage you to think about the political risks if you're buying into Alibaba, Baidu, JD, Tencent. They look like cheap stocks. They could be good opportunities, but you've got this political risk that could also zero them out at any time. And therefore, I think you gotta be smart about how you size them. And that's kind of my thoughts on it. Obviously, everyone can have their own opinion, but looking at it as factually and as rationally as we can, that's kind of what I see today. Yeah, so Chris, what's up, man? So Chris Dunn in the house. Chris, we were talking about uranium earlier. I'm happy if people are just joining, happy to recap what's going on in the uranium market here in a little bit. We'll talk about that again. We talked about it for the first 10 or 15 minutes of the stream. Really, really interesting situation going on in the uranium market, and a lot of the uranium stocks, running heavily this week and still potentially with a lot of room to go higher with what's going on with the uranium market being essentially cornered or short squeezed by the Sprott Uranium Trust, which is now buying more and more uranium every day and pushing the price up. So yeah. So yeah, thanks Jordan, thanks Hans, appreciate you guys. Actually, hey, I'm glad Enrico was talking about some insider buying at Astrazeneca. There's been some really interesting recent insider buys on a few companies that I've been watching, and actually a company I own as well, like Oscar Health was one. This is a kind of a new age health insurer that's really focused on like customer experience and trying to take share from a lot of the old stodgy health insurers in the US. But this is a busted IPO. The Oscar Health stock IPO'd at $39. There were institutional buyers of Oscar's stock at, I'm going to go ahead and zoom out on this a little bit. You can see this stock IPO'd at $39 a share. There were institutional buyers that bought stock at $39 a share. Has pretty much traded all the way down since the spring when it IPO'd, and traded down to, I guess it bottomed out about $12.50. So at about a third of where it IPO'd. So it was down about 2/3. And the financial results of this company were actually pretty good. It's not like they reported bad financial results. They've been reporting escalating growth, so increasing growth in the customers that they serve, and overall growth is at like 30-35% a year, so still very, very healthy. They aren't yet profitable. That's kind of the one knock against them. And investors aren't really loving like insurers right now. But other than that, like everything looks pretty solid with the company. And really, really good backers. IPO'd at 39 bucks a share, traded down like 2/3. Reported really good results for Q2. And then you can see if you look at the insider transactions here, we could look at this a few places like Open Insider or FinViz or BAM SEC. You can see, though, Thrive Capital Partners, which is an investment firm that had been invested in Oscar already, started buying more. They started buying more pretty aggressively at prices from about $12.75 all the way up to, I guess, about 15, 16 bucks. And they've spent, I think, about $30 million of buying stock here just in the recent last 2 weeks or so. So that was one that caught my eye as an insider buy. We've had some other cluster buys that showed up in some of the beat up SPACs like Catapult Holdings, and Catapult's doubled since the insiders were buying. You can see here a lot of insider buying. Now this stock missed its initial guidance. They had a horrible quarter right off the bat, and the stock gapped down from like over 10 bucks down to like 3 bucks at the bottom. So it was down like 60-70% within like 2 weeks. Has come back pretty far. I'm not sure if it's justified this comeback yet. But again, management was buying down here. These are great signals sometimes to watch, especially on stocks that are really beaten up. When you see management come in with conviction and buy a lot of stock, these were pretty decent sized buys. You can sometimes take that as a signal that management thinks that, the stock's undervalued and there's, more positive surprises to come. So let's take a look at Astrazeneca. That one was one that I hadn't seen or didn't cross my radar, but let's take a look. Insider transactions, according to... so this one's tough because I think this is also a foreign stock, right? Insider transactions don't always show up properly on some of these sites if they're international stocks. According to Enrico, though, he's saying that there was a $2 million insider buy. Let's see if like FinViz or someone like that might have it. AZN is the ticker on Astrazeneca. So let's see. If we scroll down here, you can see insider buys and sells. I don't see that here though. We could also maybe go to their investor relations site. Sometimes, companies have to report these in their, their investor relations filings. Let's see. Governance, shareholder information, stock exchange announcements. So this might be it here. Let's take a look. It does look like perhaps this was it. Chief Financial Officer. This was an award grant. So this wasn't a direct buy. This was a grant of some shares for, executive grants. But yeah, I don't see anything. I could be missing it. So if you've got a link to it, let me know. I don't see anything right off the bat as far as an insider buy, but I could be wrong here. Yeah, these look like grants of shares. So I'm not seeing it. We could also check. I wonder if Open Insider has it. Let's take a look. You can filter. What's cool about Open Insider. So this one's tough because they don't, being a foreign company, they may not have to file SEC Form 4. It's not totally clear to me. I could pull up Centeo. Maybe they have the documents here. But yeah, you always love to see insider buying on companies that you own or companies that you're looking at. It can often be a very bullish signal. Not always, but especially if they're really large conviction buys where they're putting a lot of capital behind it. But yeah, let's see. Usually even foreign companies, like, they have to often report if there's a insider buy. So it looks like, and I don't know. Yeah, so I don't know. We'll have to double check that, but holders, institutional shareholders, beneficial owners. Let's take a look. Yeah. AstraZeneca, I'll have to double check that offline and see if I can dig up what you're seeing. See what was up today. Oh, MongoDB had, what happened on MongoDB today? It was up 26%. Was it an earnings beat? Yeah, it looks like they had a pretty big quarterly report here. It looks like they beat estimates. Looks like revenue was up 44%, pretty big beat. And then guidance looks like pretty strong guidance, a couple million above consensus for next quarter. And then for the full year, it looks like they raised guidance 805 to 811 million versus consensus of 786. So yeah, stock was up pretty nicely today, about 26%. I don't own Mongo, but I've always kind of watched that one from afar with the JOMO, joy of missing out, because the like the company, like the product, just never really thought it was cheap enough to own, but clearly I was wrong. And I do own PagerDuty, which had a really, really solid quarter. Unfortunately, that one had a little bit of a kind of a pop and then a little bit of a drop throughout the day. Still ended the day up about 7% or so. Still up pretty nice. I think I bought this one around $34-$35 average cost. So kind of caught the yearly bottom here. Bought that one a few months back. It alerted the community, and yeah, pretty nice return so far. So about a 30-40% return so far. It's not bad. Yeah, John, I've got I'm mentoring a community called the Skill Incubator Wealth Building Community. I'm gonna go ahead and pull up the site here so I can show you. But yeah, if you go to like skillincubator.com and click on like the join the community thing, you can kind of like see some more information about what we do. But yeah, we basically cover crypto stocks. I cover stocks. We have a certified financial planner as well, Nikki, who handles a lot of tax questions, things like that, asset allocation. Rocky and Chris do crypto. They're really, really good at basically trading different cryptocurrencies. And then I cover stocks and do everything from like trying to call out interesting shorter term trades to looking for like asymmetric, risk reward type of setups, and then longer term investments as well. I do a lot of like, kind of deeper research focus on just trying to find stocks that'll double or triple over the next few years. It's a paid community. We have a Discord channel. And yeah, we do like education classes. We have some free courses as part of the like subscription and things like that. So it's pretty cool. And I alert like most or pretty much all my trades and kind of give updates on what I'm holding in my portfolio. And then I have once a week I give a good like 2 hour update on what I'm seeing in the markets and talking about the stocks in our portfolio, covering earnings releases, things like that. So pretty in depth there as well. Jordan, great question. So Jordan's asking, what do you do when you find a B stock like C Limited or Mercado Libre, like kind of late, right? Like that's so tough because like look at these stocks, right? Mercado Libre has been an absolute monster. It's up like 10x in the past, 5 years. C Limited, I think, is about the same, but even an even faster time frame. If you'd found this in 2019, you'd be up 30x. And that one wasn't one that was even on my radar, based out of Southeast Asia. Like I wasn't like as familiar with that market. And they've just absolutely crushed it from a fundamental perspective. They're now moving into Latin America, having some success in e-commerce already in countries like Brazil. So a couple things to say on that. I think some of these things get overheated, and I don't like to chase parabolic stocks. But at the same time, when you find companies that are fundamentally working and they're growing at high rates and they have like an actual business model that is very defensible, a lot of the past few years have shown us that paying high prices doesn't necessarily hurt you, because if these companies continue to compound at high rates of growth, they can grow into their high valuations pretty quickly. Now it still makes me nervous. Like I don't like to buy the most expensive stocks in the market, because if the market turns, if you have a market environment like 2020 or even like late 2018, the stocks that get crushed the hardest are usually the ones that are valued the highest, because they have the furthest to fall, because the valuation multiples can have so much compression so quickly. Because so much of the value of the stock is not the actual underlying earnings, but the earnings multiple. And when those multiples get up to 50, 100, 150 times earnings, what's the difference between a stock trading at 100 times earnings and 150? On the upside, the market doesn't seem to care, right? It'll just keep pushing up the valuation multiple. But when the market turns and it goes from 100 times earnings to 50 times earnings, it gets cut in half, even though the actual business is still doing well. So I always say that like the price you pay matters to your ultimate return, as does the actual underlying performance of the company. So it's those two things both. It's like how good is the company operating and growing, and what price are you paying? There is such a thing as paying too high of a price. And so it's tough, like, because these companies that are doing so fundamentally well can grow into their earnings, can grow into their valuations relatively quickly. Within a few years, an expensive stock can actually become fairly inexpensive. But at the same time, if they get to too egregious of a valuation multiple, then it creates a valuation headwind. And let me show you a perfect example of this. When we go back to a time frame, I'm sorry that I keep drinking. It's just like I'm talking a lot, and so I'm thirsty. But when we go back and look at like the darlings of the last tech boom, right? You look at Cisco and Intel and some of the companies that, like, you can see, like Cisco back in, I know this is like old school, but this is back in like the mid to late 90s. Cisco was crushing it. Went from, a split adjusted $1 or $2 a share to like $80 a share at the high. It was like a 50 bagger. It was a 50 bagger in a matter of like 4 or 5 years. Very similar parabolic looking chart to what we see on some of these hot high flyers today. And you cannot deny Cisco's business was crushing it back then. They were growing at crazy high rates. And then the dot-com bubble kind of burst. And even though Cisco continued to grow, actually, I will show you a better chart for this. Let's just go ahead and pull up side by side the price chart with the chart of Cisco's earnings, because I think this will be helpful. And so if you look at, let's just go ahead and let's pull up earnings before interest and taxes. That's operating income, or it's like a good proxy for the amount of money that Cisco was earning. And we'll just go ahead and do LTM. We'll go back 20 years. Actually, we'll go back even further. And let's also pull up Cisco's price chart. Let's see, price change. Well, actually, price return is maybe not the best. Let's pull up the stock price. How do I pull up the stock price on this? I know there's an easy way to do it. Let's go ahead and historical price graph. That's what I'm looking for. And we're going to split these into two panes. And I'll make this bigger so you can see it. And I'm actually going to remove my face for a second so you can see it. Let's do this. Okay. So here is a chart of Cisco from 1990 to 2021. And you can actually see, let's make this date range. Let's actually change this date range and go back to like a little earlier. So you can see here, Cisco's, in fact, I'm going to change the time frame to look a little bit. Let's go back to like 1998. And let's go back to like 2005. So you can see Cisco actually did have a fall off in earnings as well, but recovered pretty quickly. But you can see Cisco's earnings before interest and taxes was growing from 2000, 1998, 99, 2000. Took a little bit of a fall, but started to recover. And actually Cisco's earnings were higher by like 2003, 2004. They were already growing earnings again. But look at the price. It did not recover until well after like 2006, 2007 timeframe, I think. like it really didn't start to go up again until like early 2010, 2011, 2012 timeframe. So like you had a situation here where the fundamental business was actually still doing pretty healthy, but the stock price was so overvalued in 99 2000 that it didn't recover for a long long time, even though the business was doing much better. So here you can see Cisco went parabolic, then it crashed all the way down, did not really, it's still today not at its all-time high, and your return would have been pretty bad for like the next 20 years for Cisco, unless you bought it at one of these bottoms. So that's the tricky part with buying some of these companies. Like even the companies that are doing fundamentally well, if you overpay and the market starts to compress earnings multiples for hot growth stocks, then you could be looking at years and years and years of weak returns on some of these stocks, even though today they look awesome. So that's kind of the concern, is like what I try to find is, how can I find companies that are growing but that are at reasonable prices? And so some of the ways that I might do that is I might go to I might look at a universe of growth companies out there. Like right now I'm on a platform that I use called Centeo. There's other platforms you could use like Koyfin. You could even do this as well. Koyfin has a histogram, but I'm just going to pull up one that I've already got on here because I just created one the other day. But essentially you could come and do like a comparable analysis and look at, I have this list of growth stocks. It's hard to see here, but you can see like some of the stocks on here would be like Zoom and Zillow and Zendesk. We're just going from Z to A here. Uber, Unity, Twilio, Trade Desk, Tesla, Atlassian, Teladoc, Stitch Fix, C Limited, Roku, PayPal, Poshmark, Palantir, PagerDuty. I'm just naming some, Okta, NVIDIA, of course, Monday.com, MongoDB, Fastly, DocuSign. I'm just naming some of I've got a bunch of them on here, as you can see. Coinbase. These are all high growth companies for the most part. And so what I can do is I could look at a scatter plot or a histogram, and I could graph. For instance, I could look at the growth rates. So if I pull up here, I actually need to get some different metrics here first. So if I pull up these different metrics, so you can see here now, if I take my scatter plot, I could graph like the most recent growth rate of revenue. So I could do like the revenue percentage change in the most recent quarter, and then I could graph, say like the price to earnings or price to sales multiples, EV to sales next 12 months on the y-axis. I'm going to remove some of these outliers like Coinbase and Upstart to make it actually look a little bit easier on the eyes here. But let me find, where is Coinbase here in here? See, I've almost have too many tickers on this one, but if I remove Coinbase, let's take a look. Where is it? I can't see it. It's kind of silly. I have to like find it and then click on it. Here we go. So now, and I could even remove a couple of these, Airbnb and DraftKings. I could remove those too. Lightspeed. If I remove a couple of those outliers, because Airbnb is growing at crazy rates this year because they're growing versus last year when the business was basically shut down. So it looks like they're growing at crazy rates. But even if I don't remove those outliers, you can add a trend line, and you can see like what is the growth rate versus the earnings multiple, right? And you can find outliers. Like these are the most expensive stocks up here, like Cloudflare. Cloudflare, is trading at an EV to sales multiple of 54 times next year's sales, and its revenue is growing 50%, but it's still an outlier because you can find other companies that are growing at high rates as well that are trading, down here, like PubM, which is growing at 88% in the most recent quarter. They actually trade only for an EV to sales multiple of 7.3. Now, of course, there's going to be some differences in business quality here. But as you can see, you can find stocks that are trading at much lower relative multiples. I'm going to go ahead and take out some of these outliers so you can see this a little better. Let's take off DraftKings real quick. Let's see. And then let's take off Airbnb if I can find it in this list. Like I said, I've got too many tickers on here, but here's Airbnb, and we could remove Lightspeed and Carvana as well if we want to just to kind of make it a little bit easier to really look at the groupings in here, which I think would be more helpful. Let's take off Carvana and Lightspeed. And if you help me find Lightspeed, we'll take that one off, and then this chart will look a little bit easier on the eyes. So here we go. Like now, if we look at this, you can see, especially in this cluster here, like let's look at this. This is Atlassian, and Atlassian is trading at 37 times enterprise value to next 12 months sales. And its revenue has grown at about 30%. But if you look, you could actually find a company like ServiceNow, which is trading at which almost has the same exact growth rate. Its total revenue growth rate last quarter was actually a little bit higher than Atlassian's. It was growing at 32% year over year, and it only trades at an EV to sales multiple of around 20. So you've got Atlassian growing at the same rate, trading at an EV to sales multiple almost twice the level of ServiceNow. So you might look at that and say, well, maybe it makes sense then to take a harder look at ServiceNow and figure out, why it's much cheaper, or maybe Atlassian is just overpriced relative to its growth. Or maybe there's, maybe investors are expecting Atlassian to accelerate its growth or something like that. You have to dive into the research and know why these differences are existing. But sometimes it really just is a matter that some stocks are cheaper than others and offer better value. So for instance, Upwork's actually a great example. Upwork is still a relatively cheap stock relative to its growth rate. I mean, Upwork's growing at 42% last quarter and only trades at an EV to sales multiple of 10 times. So it's trading at like one-fourth the level almost of Atlassian in terms of its EV to sales multiple, its valuation multiple, yet it's growing at almost 30% higher, or 10 percentage points higher in terms of revenue growth rate. Bumble's trading also around 10 times EV to sales and growing at almost 40% year over year, and is having a great year. PagerDuty, which I own and just reported a great quarter, grew at 33% year over year and has been accelerating its growth in the recent quarters, and yet still only trades for an EV to sales multiple of 11.5. So relative to these other software companies trading at 20, 30 times sales, PagerDuty to me looks like a pretty good value, right? So you can kind of find these relative values sometimes. At least it gives you a starting point to go maybe find some growth at a reasonable price. And I like doing that because, sometimes you can find some gems that just haven't been picked up by the market. I talked about Upwork last year. It was one that I was buying in the like low double digits and high single digits. And for a little bit of time, it looked like I looked kind of stupid because this stock was a busted IPO. You can see IPO'd at 20 to 22 bucks. I started buying it like I think around 12 or 13 bucks. I was down. It went down to like 7, 8 bucks, right? And part of this was because of the sell-off in the market for coronavirus. But I was down like 30, 40% on the stock. But if you look at the valuation multiple and the actual fundamentals of the business, this stock never had bad fundamentals. Let's just go ahead and pull up the historical financials. And I'm going to show you quarter by quarter here. So we'll go back. Here I'm showing the most recent on the left. And as we go back to the right, it gets older and older. Let's go back to that time frame when it was trading at, when it was trading down in kind of mid to late 2019. And you can see here it traded down in like pretty much all of 2019. But if you actually look at the quarters here, they're reporting 15, 18, 22% growth, 20% growth. Their margins were getting better. Look at their gross profit margins. Their margins were going from 68, 69, 70, 71, 72. Their margins just kept getting better and better, 72, 73% margins. And I don't know if this is big enough for y'all to see, but look at these growth rates. They started accelerating. And so you had this situation where, I lost my bar. So you had this situation where growth started to actually go higher and higher on a percentage basis. So second quarter, third quarter started growing at 24%. Fourth quarter started growing at 33%. And when we look at the graph of the historical earnings multiple, or let's look at a revenue multiple for Upwork. We'll just go ahead and look at EV to sales multiple. You can see on if you go back to like 2020, 2019, it was only trading at like 2 or 3 times EV to revenue. You've got stocks I just showed you like Atlassian and Cloudflare trading at 40 or 50 times sales. Whereas Upwork was a pretty healthy business. It wasn't growing at like crazy rates, but it was growing 20% and improving margins. And then growth started to accelerate. And you went from a revenue multiple of 2 times, and revenue's growing also, by the way. And then you start to grow. But even here, even in the middle of 2020, it was trading for 6 times revenue. So it started to recover, but it was still like, even in here, you could buy it for 14 or 15 bucks, and it was trading for like 1/3 the valuation multiple of similar companies growing at similar rates. So it was such a good relative value back here. And then, of course, the stock finally woke up and it went on to be like a 3-4x. So that to kind of summarize is what I try to think about is like, can I find stocks that are both growing and doing fundamentally well, but that also like are priced at a reasonable level so that, I have a high probability of getting a good return? Because if the market turns against me, like the valuation multiples doesn't have as much room to get compressed. It's not going to be like an Intel or Cisco from the dot-com bubble. Growth stocks, when they're working, they can get, acceleratingly high valuation multiples. But I get scared about paying too high of a multiple, because then you can just get crushed like it happens all the time in growth stocks. What's a recent, like Fastly? Fastly's kind of a recent one, right? Fastly, it was kind of a darling, seen as a similar competitor. Cloudflare was growing really nicely. Let's take a look at Fastly's multiples. Once Fastly's growth started to slow down even a tiny little bit, the valuation multiple got hit. So you look at a 1-year chart, you can see it used to trade at 20 or 30 times sales, kind of similar to Cloudflare, and now got crushed down to like 12 or 13 times sales. Now, if we look at the actual financials of the business, like let's look, you can see it's still growing at 30% a year. Actually, it looks like they grew only 14% in the most recent quarter. But in quarters prior, here's the problem, the growth rate started to decelerate. So it's still growing. The company still got growth, but it's just slower growth, right? And so at some point, the law of large numbers kicks in for some of these growth companies, and they will start to decelerate. It was growing at 60% a year ago, but it's now growing like lower than 20%. And so that's why the valuation multiple got absolutely crushed. And you could say, like, even if you invested at these prices up here, you'd be like, well, the company's still doing pretty well. It's still growing. It's still got a big market. It still will probably grow for the next 5 or 10 years, but you just paid a little bit too high of a price up here. Now, it probably will get back to that price at some point if the company continues to grow for a decade. It'll eventually grow into its valuation multiple, and the underlying growth will eventually start to take back over. But, again, that's the danger of paying. So when I look at SE and I'm like, man, it's such a good business, or like if I look at Cloudflare, I love Cloudflare's business. They execute so well. But I'm like, I guess I just missed it. Like, I should have been looking at this one when it IPO'd and been willing to pay. If I was willing to pay 15 or 20 times sales for it at IPO, it'd be great, because now it trades for 50, 55 times sales. So unfortunately, I think I missed this one, because I'm like, yeah, it's going to continue to do well fundamentally. But if I pay 55 times sales, statistically, I'm probably likely to go into a pretty big drawdown at some point. So maybe I'm just better off finding better relative values for now and waiting for this thing to have a correction. And, if it has a Fastly-like correction, then I can pick it up on sale. And that's kind of my thinking, I guess. So, yeah, I mean, that's where my head's at with some of this growth stuff. One other thing that I have to mention on the growth stock side is that you have to be cognizant of what else is in your portfolio. If all of the stocks in your portfolio are like high tech or software growth stocks, they're all going to be correlated. Like if you pull up a correlation chart, when there's a drawdown in the market, they're all going to go down at the same time. Or if interest rates spike, and growth stocks sell off, they're all going to sell off at the same time. And so essentially you own the same type of asset. Even if you were technically in 10 different stocks, if they're all highly correlated to one another, they all go down at the same time, which you don't want. So you kind of want to sprinkle, like in a portfolio, in an ideal portfolio, you want it to be able to smoothly, like consistently grow over time. It doesn't have to go up every month, but every year or every year and a half, you want to have a good overall return. And so you want to sprinkle in stocks within the portfolio that perform a little differently. So when some of your stocks are going up, maybe some of your other ones are having a little bit of a breather. And then when these other stocks that have been going up start to cool off, well, then the other stocks start to pick up, right? And so you want to pay attention to like correlations within your portfolio and think about, maybe if I have a bunch of high growth stocks in the portfolio, maybe I want to have some more value stocks or some, commodities or something that performs differently in terms of returns. And a way to look at that is to like look at correlation. So, for instance, I'm just using an example here of like Fastly. Actually, why don't we do this? Why don't we correlate like Cloudflare and some of those stocks that we were just talking about that are like expensive stocks. Like let's look at Atlassian. And you can see here over like a multi-year time frame, in most time frames, it looks like Cloudflare and Atlassian are pretty correlated. Like 0.7, 0.8 times, an R squared value is a pretty high correlation. Basically means they're moving in tandem a lot of the year. The same could be true, like you could correlate to other stuff like Shopify or Roku or something like that, right? Look how correlated these are. I mean, Cloudflare and Shopify are fairly correlated, 0.6, 0.8, sometimes the correlation drops, but for the most part, it's correlated. 1 year correlation, you can see pretty heavily correlated most of the time. Or you could look at like Tesla versus, Tesla and Roku or Tesla and Shopify. Again, very different businesses, but strangely seem to be fairly highly correlated. Let's look at Tesla and Roku over a 1 year time frame, a little less correlated there. So Tesla and Roku maybe have slightly different drivers. They were pretty correlated back in the spring, but less correlated now. You could look at, what if you owned, SE and Melly, right? You own C Limited. And if you correlate that with Melly, Mercado Libre, it looks like most of the time pretty highly correlated. Although recently it looks like there's been a break in the correlation, maybe just recently. But that really didn't start to happen until like August. So fairly highly correlated would tend to move in tandem. The other thing you could do if you want to see this visually is you could actually just overlay the two on a price chart or something like that. And you can kind of see when C Limited's going down, Melly's going down, when it's going up, it's going up. Even these seem to have some of the bigger spikes at the same time. But there's obviously a gap in performance. They don't move exactly 1-to-1. But you can see how correlated at times. Like look how correlated these were back in, late last year, early this year. These were moving almost step for step. You can see how correlated these are. So if you own both of these, you might think you're diversified, but in reality, they're going to perform the same. So you always want to take into account when you're looking at your overall portfolio is how correlated are my stocks. It's okay to have some correlation between some of them, but you don't want all of your stocks to all be like so correlated that if the market stops liking tech for a couple months, then your portfolio is going to get really crushed. So yeah, that's hopefully helpful. I don't know. I went on a long rant there. Yeah. So did everyone catch the uranium stuff that I was talking about earlier, or should I recap it? I think most of y'all were here for the uranium stuff, but oh, Enrico missed it. Okay, so I'll give you a brief recap of uranium stuff because I know I titled the stream Something about the uranium squeeze or the cornering the uranium market. All right, so the uranium market, physical uranium. Uranium is obviously a commodity that's used to power nuclear reactors. There's a few hundred nuclear reactors worldwide. There's about 100 nuclear reactors live in the U.S. currently. But there's only like a couple of big uranium producers that produce most of the world's uranium. It's Cameco, Orano, and Kazatomprom. Produce like 80 or 90% of the world's uranium. There are some smaller producers as well, but for the most part, it's a fairly concentrated market. You have big utilities. They buy uranium from the big producers on like 4 to 5 year contracts. And when we look at the price of uranium over time, like for instance, looking at the uranium futures, you can see they kind of, they don't move up a lot. They have been moving up over the past 5 years from about $20 a pound to about $30 a pound. But you can see they've been kind of in a downtrend on a longer term time frame. If you look at uranium, going back, 10 or 20 years, it's kind of been in more of a downtrend here and has just started to perk up a little bit. But, the world is, starting to change a little bit when it comes to uranium. So there is a new closed-end fund called the Sprott Physical Uranium Trust. Sprott is a company that is, they are an investment firm that are involved in various commodities. They have closed-end funds and ETFs and funds that focus on commodities like gold, silver, platinum, uranium now. So they launched this physical uranium trust back in mid to late July. And what's interesting about this uranium trust is it's starting to participate in the uranium market. So it is taking in capital from investors and using that capital to buy physical uranium. Now, why that's so interesting is uranium's been in a bear trend for the better part of the last decade. Utilities have been buying their uranium, mostly in long-term contracts with the big producers, but occasionally the utilities will buy in the spot market when they need. I'm going to go ahead and close this out. Sorry, guys. This thing is giving me messages in my headphones. Okay, so the utilities, when they need uranium that they don't have from their contracts, their existing contracts, they go into the spot market and they buy, but they never really had to push up price very much because uranium prices have been in a bear market. Well, this is where the Sprott Physical Uranium Trust comes in. They're essentially cornering the market in uranium right now because they're buying up all the excess spot uranium. As more and more investors see this and they see the Sprott Physical Uranium Trust starting to do well because uranium prices are going up, they then put more capital into Sprott Uranium Trust. We'll just pull up the Sprott Uranium Trust here. You can see in the last month, the uranium trust has gone from about $10 to about almost 14 just in the past couple of weeks. So now that its performance is improving, investors are like, this seems like a good idea. This seems like a good investment. We're going to pour more money into Sprott Physical Uranium Trust. So you have more buyers buying into Sprott, which means Sprott has more money. Sprott goes into the uranium market, is buying more uranium, pushing up uranium prices, which then causes uranium trust to go up in value, which means more investors are attracted to it in this virtuous cycle. And so the more money that goes into this uranium trust buying uranium, the higher uranium prices go, and the higher the trust goes, and the more money comes into the uranium trust. Again, it's a virtuous cycle. And this is the first time that you've had a significant buyer that's not a utility company in the spot market of uranium, and it's starting to really have an effect on uranium prices. Again, Sprott Physical Uranium Trust is maybe going to corner the spot uranium market. And so if you look at a long-term time frame chart, you can see uranium back in the early 2000s traded as high as like $100 per pound. And now uranium is starting to perk up. It's only at about $33 a pound. And with Sprott buying more and more uranium, I think it's possible for us to see $50 to $100 per pound prices again on uranium, which means all of the small uranium producers, and you can see here, let's see, I'll go ahead and make this bigger. And, let's see. You can see here on the list of uranium producers, a lot of these uranium stocks are starting to go up a lot. They're starting to go up by look at the last 5 days of trading or the last even couple weeks of trading on some of these. You can see they're up 10, 20% a day, and we're just getting started with higher uranium prices. So when I look at stocks like Next Gen Energy, even the bigger producers like Cameco or Kazatomprom their stocks are starting to move because, the higher prices of uranium means more earnings for these companies that produce uranium. So we're starting to see this become a pretty big trade. We're seeing investor capital starting to move in to this trade more and more as well. So yeah, it's a game changer. The Sprott Uranium Trust is cornering the market in uranium, essentially creating what we might call like a short squeeze type of situation with uranium prices. And it's still pretty early, I think. I still think, again, if you look at like a 5-year chart or a longer term chart of uranium, we're still kind of in that low $30 range. And I think we could see as high as $50 to $100 uranium prices if the Sprott Uranium Trust keeps getting more and more money and they keep buying more and more uranium in a very thin market with not a lot of providers of excess uranium. We're going to see higher prices, and that means these uranium producers' stocks could continue to go up a lot. Even though they're already up a lot in the last couple of weeks, these things could still double or triple in value in the next couple of weeks. And so it's a very, very interesting situation here with the uranium trade and Sprott Uranium Trust cornering the market. I don't know why every time I do my shortcut key, it switches it to a different tab in my browser. So yeah, what else is going on, everybody? Yeah, this trade, by the way, this uranium trade is very similar to what happened with GBTC, the Bitcoin closed-end fund that was buying so much Bitcoin back in late 2020, early 2021. Remember how GBTC went crazy, and it was because, remember that GBTC was buying Bitcoin, which was helping push the Bitcoin price up, which then created more demand for GBTC because Bitcoin was going up, which then gave GBTC more money to buy more Bitcoin. And as a virtuous cycle, so GBTC kept buying more Bitcoin, Bitcoin would go up, more people buy GBTC, they buy more Bitcoin, so there's a virtuous cycle there for a while, helping push Bitcoin up. And it's kind of a similar situation happening in uranium. And I mentioned earlier silver. Silver had a big short squeeze or cornering of the market by the Hunt brothers. It's a famous thing that happened in financial markets back in 1980. Let's go ahead and pull up the silver futures. Let's see here. If we go back, you can see this was back in. Can y'all see this? I'll try to make this bigger. If you look back in 1979, 1980, silver was up 10x because the Hunt brothers cornered the market. They were buying up all of the available silver, and everybody else who needed to buy silver had to pay higher and higher prices. And that's kind of maybe what could happen here in the uranium situation. We'll see. But yeah, pretty interesting little trade idea there. So we'll see what happens. Again, I think it is possible to have a pullback here. I don't know that these things are going to go up every single day like they have been, but it's a trade that I still think has more room to run overall, and I think there's potential for some of these stocks to double in value again. So yeah, what else is anything else on your minds? I guess it's Friday. We're markets closed now, and we've got here in the U.S. a market holiday on Monday, which is good and bad. I get bored when the markets aren't open, but it gives me time, I guess, to focus on more quiet research, and maybe leisure. But yeah, maybe it's time for a beer or a glass of wine since it's Friday at 4:15, huh? What are y'all doing this weekend? Are y'all got any fun plans out there for the long weekend, or just taking it easy, or? I'm going to pull up, John was asking about Shake Shack as well. We'll talk about that one. So yeah, Shake Shack's interesting. Shake Shack historically has been like a fairly highly valued stock, but looks like, it's had a kind of a big pullback. So let's check in. It's been a while since I've checked in on the overall valuation of Shake Shack. I guess the concern would be are there existing stores still performing, and what is what does the outlook look like? Because I know a big part of the story there is that they still have a lot of room for expansion. But one thing I've always wondered about like Shake Shack is, isn't it so competitive in their niche, in the hamburger, cheeseburger, French fry niche? Isn't it like so competitive? Like unlike Chipotle, where you don't have a lot of big competitors, really, in that cheeseburger space, you've got so many different competitors. Obviously, your old school ones like McDonald's and Burger King and all those, but you have a lot in the fast casual side. Five Guys, you've got. I'm drawing a blank, but like Shake Shack, Five Guys, you've got Culver's, you've got local ones like Whataburger in Texas and P. Terry's. You've got what's the new one that did a SPAC? BurgerFi? Is it BurgerFi? BurgerFi? Yeah, I think it's BurgerFi. So you've got just like a lot of competitors, right? It seems to me like the whole burgers and fries and milkshake space is like just so crowded. And that kind of worries me about like the long-term growth potential of Shake Shack. But you can see here, it does look like growth has been a little bit weak here relative to what I would like want it to be. I'm not sure if these numbers are correct though. These numbers look kind of wonky. Let's just go ahead and pull up their investor relations site. I wonder if they have a presentation. Yeah, here we go. We've got an earnings presentation from Q2. Let's check in with Shake Shack. It's been a while since I've looked. I actually really like their products. We've got a couple Shake Shacks in the town I live in. I think they're a good quality product. Really love the burgers, fries, milkshakes, etc. But weirdly enough, when it first opened, the one that's closest to me when it first opened was so packed. It was like line around the block. But in like the last year and a half, it's been pretty dead. So that kind of concerns me a little bit. It's like, why? Maybe it's just this one location. I don't know. I know a lot of their locations on the East Coast are still doing very, very well. In-N-Out, that's another one. I forgot about In-N-Out because I was thinking on the West Coast, you got In-N-Out, and everybody loves In-N-Out on the West Coast. But on the East Coast, Shake Shack is really big. But here in Texas, like Shake Shack seems to be like some of the locations are good, some of them are kind of weak. And so that kind of makes me wonder a little bit about the long-term growth potential. But okay, this looks pretty good. So you've got revenue that grew over 100% in the most recent quarter. That's obviously super good growth rate. The same shack, they have a metric that they call the same shack sales. And that would essentially be like other retailers or restaurants that report same store or same restaurant sales, which means comparing the restaurants that have been open at least a year, comparing their sales now to the same time last year, what does the rate look like? Because you don't want to muddy the water with all the new stores that they open, which are going to look really good. You want to look at the growth rate of the existing stores too to see if those are still growing. So same shack sales, as they call it, up 52% year over year. That's a very good number. Now, I guess the question is, how much of that is pandemic related? Because you look at the little footnote here and it says, can y'all see this? It says a 12% decrease in same store sales versus 2019. So if you look at this year's numbers versus pre-pandemic numbers, it looks like the restaurants on average are actually a little bit worse. They've actually shrunk a little bit in terms of growth versus pre-pandemic. So that is a little bit of a concern there. You'd want to see positive same-store sales over time. A quarter or two here or there is not a big deal, but you would ultimately love to see them growing their existing store-based sales. Over time, you want to see a positive same-store sales number. So that's kind of a concern. They did have positive operating profit at $34 million, so pretty good margins, about 19% operating profit margins. That's really healthy. Adjusted EBITDA margins of about 11% as a percentage of revenue. Again, that's a pretty healthy number. I know Chipotle, I think is around what? I want to say they were around 20 or 25%. So there's definitely room to grow those margins over time. And you want to see the same store comps be better. So that's the real concern. My guess is that's why the stock has, taken a tumble from 120, 130 down to 85. Is that it looks like maybe they're starting to struggle to grow a little bit with the existing stores. So It does look like, yeah, I mean, you can see here, yeah, it just looks like a little bit of a fall off. They are still growing the store base overall too. So you want to really see two things with a restaurant concept. You want to see two things. You want to see growth in the existing store base. So the stores that have been open for a year or more, you want to see those still growing, their overall sales. And you want to see new restaurants opening and the new restaurant openings going well, right? Because it's like you get growth from the existing stores and you get growth from the new stores that are being opened. And if you're a small restaurant, you still could have a lot of growth potential by opening new stores. Unless you're McDonald's, right? McDonald's has like 4 or 5,000 McDonald's across the U.S. and Canada. I mean, how many more McDonald's can they really add, right? But Shake Shack has looks like about 340 stores. They're never going to be able to be as big as McDonald's probably, but you could imagine that there's potential for maybe 1,000 or more Shake Shacks, assuming that the concept is well loved and that the existing stores are healthy. You could assume that they could get a lot of growth from just opening new stores over time. I think Chipotle today, I want to say, has like 2,000 Chipotles. And then again, I mentioned like McDonald's and Wendy's and concepts like that have been around a long time have like 3 or 4,000. So you could imagine there being a lot of room for growth in the overall number of stores. But it is concerning that the existing stores are not growing more. You would think if there's only 330 stores nationwide, that the ones that are already open should be doing pretty well because there should be pretty good demand for the product. That's again my concern is like, are they being hit by competition? Like, is In-N-Out, BurgerFi, Five Guys, are they taking away some of the potential customers? And I still think there's probably a lot of potential here, but I would want to dig into the reasons for why they're not growing at a better rate. You also like to see them. Obviously, this is good to see. They are increasing their digital mix. So one thing that Chipotle's done really well. Let's just check in on Chipotle because it's a very expensive stock, but the company's been doing very, very nice. Fundamentally, from a fundamental perspective, has been crushing it. You can see it's almost been a 10x over the last like 5-6 years. Chipotle has. But one of the things that Chipotle did really well is they pivoted during the pandemic to doing mobile orders and pickup orders and delivery orders, and they do it really efficiently. So that has really allowed them to increase their overall orders and customer base, is just being so good at the online order stuff. So Shake Shack, nice to see they're calling out the digital sales. It has fallen off some, which you would expect as more people return to eating, in restaurant. But pretty good digital mix. And if they're doing a good job with the overall mobile ordering, and it looks like they're also rolling out some drive-throughs and stuff like that, that could be a really nice way to stabilize the business and grow the business over time. Just basically making it easier for customers to get the product without having to park and then go in the restaurant and order and wait for the order at the restaurant, right? You just want to make it convenient for your customers. Some customers want to eat in the restaurant. Some customers just want to get the product and get out. So the better that they make that digital ordering experience, the better. So here we have guidance. It looks like they want to open about 35 stores this year domestically. So that's about 10% of the store base. That's a healthy number. Anything more than like 10 or 15% of the store base a year is a pretty high number. So 10% is a healthy rate of growth, I think, for the overall store base to open new stores. It looks like, operating margin guidance for next quarter, 15 to 17%. That's pretty healthy. Same Shack sales versus 2020, they're guiding to mid to high 20%. I don't know what that measures against 2019, but I think overall what you need to see to get a big valuation bump here at Shake Shack is you need to see them start to grow above the pre-pandemic levels and start to really compound the level of revenues at the existing store base. Let's check in on their overall valuation multiples right now. So it looks like, let's see if we can zoom in for you. Currently, according to Koifin, it looks like the enterprise value to next 12 months sales is about 4.2 times. And EV to EBITDA next 12 months about maybe 40 to 43 times or so. Those are still pretty high multiples. Obviously not like Chipotle level. If we look at Chipotle, for instance, Chipotle trades, Chipotle trades at like EV to sales of 7 times forward and an EV to EBITDA. Actually, EV to EBITDA is relatively similar. It looks like it's about 40 times EV to EBITDA. So Chipotle may be a little bit more expensive in terms of valuation multiple, but operating from an operating metric perspective, doing much, much better. If you look at like their overall, financial highlights, accelerating revenue growth, pretty healthy EBITDA margins overall. If you look at a quarterly basis, you can see that even more, 20, 30% types of growth rates and, pretty healthy EBITDA margins overall. But yeah, Shack, let's go ahead and look at the Shack estimates. Let's see actually, you know what? Let's pull up, Seeking Alpha, because sometimes they give us a few extra years as opposed to Koifim when it comes to earnings estimates. So if we look at the earnings estimates, looking out a few years, there's not that many analysts that give estimates beyond 2023. But let's look at revenue. You can see the analysts are still estimating, pretty solid revenue growth over the next number of years. And you can see how the multiple, the current market cap to sales or price to sales multiple gets a little bit cheaper over time. If you use the same market cap and sales grow over the next few years, the stock will grow into its multiple and look less expensive in a couple of years time frame. It looks like analysts are estimating somewhere around like 10 to 20% revenue growth in the out years. And there's not that many analysts that have estimates, but if they're doing $1.5 billion of revenue in 2025, and let's just go ahead and pull up the Shack numbers again. According to Koifin, it's got about a $3.7 billion market cap, and we can double check that here. Just look at the number of shares outstanding from the last quarterly filing. Looks like about 39 million of Class A stock, 2.9 million of Class B. Let's call it 42 million shares outstanding. Most recent price was about 85. So you're looking at about a 3.5, 3.6 billion market cap. And let's call it 3.6 diluted. $3.6 billion market cap diluted. If you can do $1.5 billion of sales in a couple of years, and obviously the operating margins should be pretty good by then you're talking about trading at an EV to sales multiple looking out a couple of years of about 2.5 times or so. And that's pretty healthy. Again, Chipotle trades today for 7 times forward sales. So I think, if Shack can pick up its performance a little bit, and maybe the stock continues to sell off a little bit, if it could get a little bit cheaper in the near term if results don't pick up quickly. But it could be one of those where if you look out a couple years and you're able to hold it for a couple years, you could imagine a pretty decent return over time if it grows at the rate that analysts expect it to. Let's just look at the peers and see what their multiples look like. I don't think these peers listed by Seeking Alpha are necessarily that great of direct peers. Like Papa John's, maybe. I don't know about Cheesecake Factory. Let's look at Papa John's and see what they trade at. Again, I don't think Papa John's is the best comparable, but we could use that. Papa John's looks like it trades for, if we look at its estimates, currently trading at an EV to sales multiple of about 2.6 times. So it's trading, again, Shack is still trading at a premium multiple because we were looking at, what would the multiple be on the sales in like 2025, and Shack, if they keep growing at the rate that analysts expect them to, will be at about a 2.5 times EV to sales. That's where Papa John's trades today. So ultimately, Papa John's may be a little bit cheaper here. Of course, I don't know if it's as good of a business. But then you could look at other comps like who would be a good comp for I guess BurgerFi, although I don't know. I don't think the numbers are going to be posted really yet because it's a SPAC. Probably doesn't have the numbers in Koifin yet. Yeah, I mean, it's pretty small though. Look at BurgerFi. Like in its most recent quarter, it's only doing like 12 million of revenue a quarter. So it's pretty tiny compared to Shack currently. Chipotle, who would we consider Chipotle's closest? Maybe like Qdoba or something like that. Yum Brands, I guess, which owns like Taco Bell and Pizza Hut. Perhaps, yeah, QSR. QSR is maybe a good comp. QSR or Yum Brands, we could take a look at those and see what the comps look like there. Yeah, if we look at let's look at QSR. QSR owns a bunch of different fast food brands: Popeyes, Burger King, Tim Hortons. I think in the U.S. and stuff like that. Let's see. QSR trades for about 6 times forward sales. Now, I think QSR does have a lot more franchise revenue, so the business model might not be exactly the same, and so QSR might deserve a higher multiple because it's like higher margin. You can see if you look at EBITDA, it's like 2.2 billion on 5.7 billion of sales. Very high margin. So I do think there's a bunch of franchise fees included in this. Like franchise businesses are like crazy high margins because you don't actually have to operate the stores yourself. You just take a franchise fee, and it's essentially just like a brand licensing. And so your percentage margins on your revenue can be really high, sometimes as high as like 70 or 80%. It looks like for QSR, they probably own some restaurants and then franchise some restaurants, if I recall. But it looks like their overall EBITDA margins are like almost 40%, which is like, really, really healthy and high. So that's also why QSR gets like a pretty high EV to sales multiple. EV to EBITDA multiple is not that high, but it's reasonable. So yeah, I still think Shaq looks a little bit expensive. It's kind of like in between the valuation of like the lower quality peers like your Papa John's of the world and your higher quality peers like Chipotle, which trades at a very high valuation. So Shaq's kind of in that middle range. It's probably like I would call it almost like fairly valued right here. And you'd have to wait a couple years for the growth to catch up to really get that return. I think if this thing continued to sell off, or if it either sells off and you get a better price and it gets, pretty cheap on a relative basis, like if it trades down to 30, $40, if it trades at half the valuation it's at now, that could be interesting and compelling. Or if its actual underlying financial results start to accelerate. So if we start to see its sales growth really pick up at higher rates than it has been recently, then you could make the case that the analyst expectations are too low and that today's valuation multiples are actually cheaper than they look. And so in that case, you could get some return from here, you buying at today's levels if you believe that their growth rate is about to take off. So I obviously don't know the situation closely enough today to be able to say that or not. But I would just say, kind of looking through what we've seen right now, it looks to me like it's still relatively highly valued, but getting to a cheaper level, and if they can continue to grow a few years from now, it'll be at a much more reasonable valuation, and I could imagine an okay return. But it may just take holding it through the next couple of years to kind of realize that, because they're not necessarily firing on all cylinders the same way that like Chipotle is at current. So what else is up? SPACs, yeah, Tim, you're asking about IPOF and some of the SPACs, yeah. Yeah, interesting to see the SPAC world has kind of been, it was dead during the summer. A lot of SPACs got crushed, and now starting to see some SPACs start to trade up again. IPOF, what happened today? I didn't see. Looks like pretty big gap up on heavy volume here. Yeah, so was there news? Is there rumors of a deal? So IPOF is one of Chamath's SPACs, one of the social capital SPACs that have done deals in the past, like Clover Health and Open Door, and what other deals did the social capital SPACs do? I know I'm forgetting a few. SoFi and forgetting what else, but looks like it moved up today, 4%, got its first pop in a while. A lot of these pre-deal SPACs, so I have a dashboard I keep on Y charts of, so I'm going to go ahead and take myself off of this real quick so that you can see it a little better. So I have my pre-deal SPAC list, which are SPACs that have not, and this may not be fully up to date, but most of these are. You can see IPOF is on here. Most of these SPACs you can see trading actually below $10. There's only a few pre-deal SPACs. iPod and IPOF are now trading back above 10. Ribbit Leap, Mickey Malka's SPAC, that's trading just above 10. The Liberty Media SPAC just above 10. Pershing Square is a $20 SPAC, and it's actually trading below 20. So pretty much everything else except for the two Chama SPACs, Ribbit Leap and Liberty Media, and maybe CM Life Sciences are trading below the $10 SPAC IPO price when it comes to the pre-deal SPACs. So interesting to see that iPod and IPOF getting a little bit of a pop, breaking the trend of a lot of these pre-deal SPACs that have been trading below 10. Yeah, there's a couple I follow, like Health Assurance Acquisition. This was a really, if you look at a 1-year chart, this was one that people were really excited about. Still hasn't announced a deal. People used to pay $14-15 for this even before a deal was announced. Now it's trading $9.75. So maybe it'll get, maybe looking at it like a 3-month or 6-month chart, maybe starting to get a little bit of life here. It bottomed out around $9.65, $9.70, which is where a lot of the arbitrage funds start to buy up SPACs because they know they can buy them at $9.60 or $9.70 and eventually get $10 back in cash if they decide to redeem and not go through with the eventual SPAC deal. So there's an arbitrage, so they don't tend to fall below like $9.65. But interesting to see iPod and IPOF going up a little bit, and maybe that'll start to happen with some of these other ones. I mentioned Leap. Leap is another one where the sponsor is pretty interesting. Started to look like it was going to trade down below 10, but it's kind of bottoming out. Who else do we like here? A lot of these SPACs still trading below 10 are kind of interesting. You look at some of these SPACs have pretty high profile sponsors, like ASZ, of course, is a a Bill Foley SPAC. Altimeter Growth is a Altimeter, big hedge fund. Brad Gerstner, is it? This is a very, very successful multi-billion-dollar hedge fund, Altimeter Capital. Let's pull up their Wikipedia. Yeah, several different funds that have performed very, very well. That one is trading $9.91. Churchill Capital, of course, the ones that took Lucid and a couple other successful SPACs in the past. Some of those are still trading under 10. And then I mentioned HAAC, which is sponsor is General Catalyst Partners, which is a venture fund. Jaws Mustang. So some of the Jaws SPACs have been very successful. I believe one of the Jaws SPACs was DraftKings, wasn't it? KKR, the private equity firm, one of their SPACs below 10. Khosla Ventures, the venture fund, several of their SPACs below 10. Pershing Square, of course, Bill Ackman. Lux Health, a venture fund, trading at $9.77. Social Leverage, that's Howard Lindson's SPAC, trading below $9.70. So yeah, I mean, there's some pretty interesting ones. A Virgin Group SPAC. And then you've got SPACs with announced deals, and a lot of those are also trading below 10. So DMY Technology, taking a quantum computing company public. Concord Acquisition, that one is actually above 10. That one's been interesting because they're taking Circle, the cryptocurrency company public, which has a stable coin that's widely used by Coinbase and others, and then working on a lot of other crypto related solutions. And so that one's been pretty interesting. You've got some other ones here worth mentioning, like BowX, which is taking WeWork public. I've seen some pretty heavy call option activity on this one, but it's still trading below 10, so that's interesting. I've actually looked through the business on BowX, and WeWork could be interesting, but I think I'm going to wait for this one because I think it may trade down after the deal's done, and I'd like to pick it up at a discount. It's still recovering. The WeWork business is still not at profitability. They still need to get their occupancy up. Let's just take a quick look at... we could look at bar chart. We could look at Yahoo Finance as well. Just look at the options chain. So let's see if there was some unusual activity here on the IPOF options. I'm sure there was, but let's just double check. So if we look at, IPOF looks like IPOF, the social capital SPAC, looks like quite a bit of call option activity. It looks like a lot of different expiry dates here, but you can see the pretty heavy volume, it looks like, in the 1250 calls expiring in November. Pretty decent volume in the October calls as well. Pretty heavy volume in the September 10 strike calls. I'll go ahead and pull up Yahoo so you can see the option chains a little better on this. If we look at the options chains here, let's see if we can make this bigger. If you look at the September, you can see these had a big day, actually, these 10 strike calls. Big volume, 15,800 calls traded on the 10 strike. Those were trading for about 10 cents before today, now trading after today at about 40 cents after the couple percentage points move. So you can see a very small move in these SPACs that are trading at or below 10 bucks. A very small move can move these just out of the money calls a pretty heavy amount. I have taken some smaller trades on some of the 10 strike calls, very small dollar amounts. So far, those really haven't worked for me very well. But some of the ones I really do like are the in the money call trades as well. If you look, for instance, at let's take a pre-deal SPAC like HAAC that used to be really popular. You can go out to like January, which is still what I guess about 3-4 months away. The in the money strike calls, like the 750 strike calls, trade today for about 230. I've actually been able to pick up some as low as 225. So if you take the price of the option, the 230, add it to the strike price to get your break even on this option, if you're buying it at 230, is at about 980. So the stock has to be at 980 or above for you to break even if you're buying this option at 230. So today the stock's at 975. And we know if they do a deal, it's pretty likely it's going to trade at 10 or maybe even above 10. And so, and remember, this thing used to trade pre-deal at 14, 15 bucks. If it traded again at 15 bucks, these 750 strike calls would be worth $7.50 because they'd be $7.50 in the money, right? 15 minus your 750, they'd be at 750. So you could buy them today for 230, and your break-even price is at 980, which you're pretty much there today. But your upside could be a multi-bagger, could be a multiple of your 230, right? If this option ends up being worth 750 and you paid 230 for it, that's what, you're like three times what you paid for it. So it's a pretty interesting risk reward. Even if this stock were to go to like 1050, which is where IPOF traded up to today, this 750 strike would be worth about $3, and you're only paying $2.30 for it today. So you'd have, what is that? If you're at $3, you essentially would be at about a 30% gain just on a very small move in the underlying stock. So these SPAC option trades can be pretty good risk rewards, especially the ones that are, in the money, where you're not paying much time value premium, and you still give yourself a few months of runway for something to happen. If you go out to April, the 750 strikes trade for about 240. So your break even on that is about, 990. So if you give yourself a couple more months of time for something to happen, then you got to pay up a little bit more, but your break even is still only 990 on the stock, and today it's at 975. So it doesn't take much of a move at all to hit your break even, and anything beyond that is gravy. So I really do like these in the money option trades on these pre-deal SPACs, especially the ones that have a really good sponsor. When they have a really good team and you think they could potentially do a really interesting deal, then you definitely could see some of these, high reward potential option plays work. So I really like these. Now, not every pre-deal SPAC is going to have options on it. It will have warrants, which is a whole nother type of trade, but not that many have the options, liquid options that you can trade it. But some of these do. Some of these pre-deal SPACs, like obviously iPod and iPOF do. I think actually Leap, they may have some warrants. I think, I'm sorry, some options. I think maybe Luxay has some options, and I think some of the Churchill SPACs will have some option chains. And then maybe, does AGCB have it? Does Altimeter Growth 2 have an options chain? Let's take a look. It does look like there are some options, not very liquid here on AGCB, but there are some options, and you can go out as far out as July 2022. But your bid-ask spread is really wide, so yeah, so that's pretty much how I'm thinking. I don't want to get too overexposed to the SPAC trade because we have seen a lot of the enthusiasm come out of the SPAC market, and mostly what we've seen in the last couple of months has been arbitrage funds really kind of running the show when it comes to SPACs. I'd love to see the retail investor crew get back into some of these SPAC trades just because it was so fun and it was like created so much opportunity for big moves. But yeah, I mean, will we get another SPAC cycle? I hope so, where we start to see some of those massive SPAC pops again, possibly. I hate just watching the arbitrage funds just you know, like selling these things off to like 970 and then slowly working the price up to $10 on the deal. It's just boring. Like these arbitrage funds are just out there to make like 3%, and granted they use leverage. So their 3%, if they're levered 5 times, could be a 15% trade for them. And you do it enough times and obviously you can make real money. But, screw these arbitrage funds. Like I just did it's boring for us, right? It's boring for us individual investors who can't get 5 times leverage. And I frankly want to see that environment that we had back in January, February when SPACs were just popping off left and right, right? And you could just get all these crazy trades and you could get these awesome options trades. So I'm hoping that we'll get another really hot SPAC market again. But right now it's still pretty quiet. But maybe this it looks like HAAC got a little bit of a pop, but also IPOF really had a nice pop today, and so. I don't know. Well, let's wait and see. But I would love to see pre-deal SPACs and post-deal SPACs start to pop off again. But yeah, I mean, let me know if you've got any interesting SPAC option trades that you're looking into, and I'll definitely take a look. But I do really like the risk reward on those in the money 750 long-term call options, pre-deal SPACs that are already trading under 10. Really love that trade from a risk reward perspective. You might not end up making a lot, but you're not going to lose a lot, theoretically, in most of those situations. So yeah, love that kind of trade. Just not that many pre-deal SPACs actually have options chains where you can do that. So not that many that you can do it on currently. As far as hedges go, yeah, I think I'm going to roll my hedges and keep them on through the end of the year. They've been a headwind a little bit through the last couple of months, but it's fine. I like having them on. I think my existing portfolio can just outperform the hedges. I'm only partially hedged anyway, and I just frankly right now this is kind of a weird market. A lot of weird macro stuff still out there potentially. Delta, all that kind of stuff. I kind of like having the hedges on and just being partially hedged for downside in the overall markets, especially when you look at the S&P. Like I said, look at a monthly chart on this thing. It's been up the last 1, 2, 3, 4, 5, 6, 7, 8 months. It hasn't had a down month in eight months. The S&P just grinds higher and higher and higher. And at some point, we're going to get a meaningful correction. And I would love to just have the hedges on for that. And that would actually, give me a lot of opportunity to harvest some profit from the hedges and then use that profit to buy more stocks that are actually in that correction. So, I could make the hedges bigger, but I also don't have a strong viewpoint that the market is about to take a dive this week or next month. So if I felt like the market was mispricing the overall macro risk in a big way, I might add to the hedges. But right now, I could actually see a case being made for the market to rip higher into the end of the year, because why? If this Delta thing really is rolling over, let's pull up I think the New York Times charts are pretty good on this. You can see U.S. numbers are still kind of rising, but when you look on a global basis, you can see that, it looks like this is kind of rolling over. So if Delta starts to really roll over and this third wave is really kind of the big last bump that we see from COVID for a while, then the whole global reopening, global strong economy thesis comes back, and markets might just rip even higher. So I'm cognizant of that risk too, that the markets could just rip a lot higher, and that's why I don't really want to get too aggressive with trying to short the market here, especially because it just keeps technically showing strength. So that's kind of my thinking, is like I want to have some hedge, but I don't want to like be too bearish against the market right now. And that's kind of just where my head's at with that at the moment. But yeah, I mean, that's kind of where I'm at. But I don't know. Yeah, I'm open to other viewpoints for sure. Oh, Hans, so Voyager Digital just listed on NASDAQ, huh? I know y'all were talking about that one a couple months ago. That one's been interesting, huh? Year to date looks like had a lot of enthusiasm, kind of started to trade down, maybe starting to perk up again since crypto might be perking up. Definitely think that's an interesting company. Haven't looked at the valuation in a while. So yeah, Bitcoin kind of just hovering right there around 50K, Ethereum just under 4K. Looked like it was maybe like both of those were going to maybe break out a little bit. Like look like maybe Bitcoin, Ethereum were going to all of a sudden just rip. But starting to cool off a little bit here. So we'll see over the next few days. But could Bitcoin challenge that all-time high? Could Ethereum challenge the all-time high? In which case, I think Voyager Digital could have a pretty good run again if we see that. So it's nice to see that you'd be able to buy it here on a pullback. But like I said, I haven't really looked at the valuation in a while. So let's does it have numbers posted yet? I know it's kind of still just ramping up its business. Let's take a look and see if it gives us some numbers here. So it looks like, yeah, I mean, it's really just going from like $0 of revenue last year to like a couple $100 million this year, and then maybe even like $500 million or more next year. Current market cap, I don't know if Centeo is going to have the right numbers or not, but let's try to take a look. Market cap, according to Centeo, is like around 2.8 billion today, and that is, I guess that's in Canadian dollars. So it'd be a little bit lower in US dollars. So I think, yeah, I mean, I think 2.8, what is Coinbase trading at currently? That one's going to be like your big comparable here. Obviously, Voyager doesn't have the kind of scale that Coinbase does, but it's nice to have a reference point, right? Like what is possible. So EV to sales on Coinbase expected to be around 7.8 times this year's sales. Who knows what sales are going to look like next year, but right now trading at about 7.8, maybe about 8 times if you look at the fully diluted share count. About 8 times enterprise value to sales. So Voyager Digital, if they're going to do 200 million of revenue this year, you're trading at about 10 times EV to sales, but sales are probably growing faster than Coinbase because it's at an earlier point in its life cycle. So looking out to next year, if they can do 500-600 million of revenue or more, then the valuation starts to look more reasonable. You're talking about maybe around a 4 to 5 times next year's revenue. So I could see some upside for this. Especially if the crypto cycle heats up, especially if Bitcoin and Ethereum start to challenge new all-time highs. I think you could be looking at a $25 to $30 price on Voyager Digital again, potentially. But, you're kind of making the same bet as just betting on the crypto underlying prices in a way in the short run, because it's going to be very correlated in the short run with crypto prices. So just keep that in mind. Yeah. Whew. All right. Good day, y'all. I definitely wanted to make sure that I put the thesis on the uranium stuff out there. We did that earlier. I recapped it earlier, so hopefully you all got to hear the uranium stuff. Yeah, Tim, I'll keep this video posted on the channel. I won't delete it. It'll be available, so you can definitely go check out the uranium stuff from the beginning of the stream. after the fact. You can go check that out once this video is finished and posted. Other than that, yeah, great stuff today. Great questions. Glad we got to talk about some cool stuff. Enjoy your weekend, y'all. I know it's a long weekend here in North America, so go enjoy your 3-day weekend, and we'll get back at it into the markets Monday, Tuesday, and let's see if this uranium thing continues to pop off. And as always, we'll be diving into other stuff too. So, yeah, y'all have a great weekend, and thanks for joining.